Joining me today is Alex Crooke, Head of Global Equity Income at Henderson Global Investors and Manager of Bankers Investment Trust. Bankers was founded in 1888, the same year the Lawn Tennis Association was founded, and has managed to increase its dividend every year for 48 years, a testament to strong management and very healthy reserves. So Alex, can you remind us of your approach to research and stock picking?
What we look for in a perfect stock is a company that generates a large amount of free cash flow, and how we define that is the profits a business generates after it pays tax, interest, cost and maintaining its assets. So that free cash flow is there. It allows the company to pay us hopefully growing dividends, which we can pass on to our investors, but also allows the management to grow, invest in the company, and therefore hopefully grow dividends and profits into the future. And then finally we look at not overpaying for those assets. So we look for their historic valuations against their peers and try and make sure that we get value for our money, for our investments.
Over a third of Bankers is invested in the UK and a quarter in the US. Your own global dividend survey shows North America performing very well in the last few quarters. What's in store for these two regions in 2016?
I think the prospects still look reasonably bright for both areas. The key one is probably America, where we are expecting interest rates to start to rise, so the economy beginning to normalise in that sense. So I think how stocks and shares react to that, how companies do, how the consumer does to that increased rate of borrowing, I think is the key thing for that developed market. And the US is key for the world as well, given the size of that economy. So I think generally we still like those developed markets like, say, Europe, America and the UK. There's value appearing in emerging markets in the small risky areas of the world, but I think we're still in a cautious mode waiting to see how America reacts to those rising interest rates.
Similarly, you seem to like financials, industrials and consumer goods and services. What can we see from these sectors next year?
I think still financials very positive on. We're coming still sort of 5-6 years out of the recession, and particularly the bank sector, it's slowly getting back to health. Again, rising interest rates should be beneficial for their reserves, that they hold, the capital they hold in their businesses. And we're seeing lending growth improving. Certainly in Europe it's beginning to pick up. It's been reasonably strong in America and UK. So I think financials still generally we like that space. Industrials has been very challenging though. That's one area I think we were more optimistic at the beginning of the year, but we've had to rein back our enthusiasm there. And I think the recovery has been affected particularly by China, which has seen a slowing of industrial activity, and that's impacted I think a number of industrial stocks around the world. Elsewhere though, the consumer areas you said, I think we're generally positive there as well. I think unemployment is falling in most major markets. The price of oil and petrol has been falling, so there's a little bit more money in consumers' pockets to spend. So it's an area, yes, we're still positive on.
What wider global macroeconomic factors will impinge on bankers in the year ahead?
I think the key ones are US interest rates. We're expecting increases there, how that affects the economy. Also China and its growth rate and whether we see that begin to improve. But I think the bigger aspect is also for us is Europe. Europe has been a very difficult market, very soggy growth, no recovery really. And Europe is engaging in quantitative easing. So I think the key there is going to see whether that printing of money effectively increases inflation, increases bank lending, increases activity. And I think if we can get some growth coming there in that core market as well, that'll help many of the stocks investments we have in markets around the world.
I spoke earlier about the fantastic dividend record at Bankers, increasing the dividend every year for 48 years. Can we expect that to continue in 2016 and perhaps beyond?
Yes, I believe it will. The chairman of Bankers Investment Trust has indicated that we'll increase the dividend by just shy of 5% in this current year. And we expect that to continue because we have plenty of revenue reserves in the trust, and they should allow us to weather difficult market conditions if dividend growth slows down. So we're still in a confident mood for dividend growth.
There's been a huge interest in equity income, hasn't there, over the last few years? It's been the best-selling sector, I think, after quarter after quarter after quarter. Does that extra scrutiny make your job more exciting?
I think it's always exciting. There's always news happening and companies are reporting and events around the world. So I don't think so in that sense. I think it's nice to see investors attracted to the space. I think it makes a very good long-term investment, and I think as more investors start to look at how to provide for their pension, for their retirement, then I think equity income, dividend paying stocks are a perfect mix in that portfolio, particularly while interest rates and long-term bond fixed interest yields are so low. Again, we can provide very attractive dividend yields with the aspect of growth that you don't get in fixed interest.
And finally, Alex, if I was going to buy a stock just for its yield alone, what should I be looking to buy?
I'm afraid I'd never recommend a single stock. I believe in building a portfolio, but I think if you're looking for interesting investments with a yield, try not to buy the highest yielding stocks. Try and buy stocks with yields of 3 to 5%, so you've got attractive levels of income. But then look at companies where they've historically consistently grown their dividend and looking again for that free cash flow generation. So I think that's what makes a good stock in the income yield, but again, try not to buy just one.
Alex Crooke, thank you very much.